I've seen it all, and I've made all the mistakes you can imagine. Yeah, we can talk about this too, but like I went to lunch with a doctor that made really good money because he was wanting to invest in one of our deals, and I was breaking it down to him, like the tax benefits, the depreciation. At the end, he's like, how come no one ever told me this? I'm like in my 60s, no one has ever presented me with this type of opportunity. He was like mad, you know? It's like I've been presented with all these like venture startup businesses that I've lost all my money in, but no one ever told me about like passive investing in real estate syndication. You can actually end up making more money, have better tax benefits in the long run, and get you to your ultimate goal, whereas this option is no longer on the table. That's the big pitch to sellers is, how does this benefit them?
Hello, welcome to the Fundication Show. I'm Julie Tallman, and this is Christian Sadler.
Hey everybody.
And we would like to welcome you to another episode sponsored by PREIshare. Today we would like to welcome Clay Rockwood with Soar Capital Group. He was one of the very first sponsors to be approved with PREIshare, and he was one of the very first sponsors to be on the Fundication Show. So we want to welcome you back.
Thank you. I'm glad to be back.
Of course. If we can start with you by telling us a little bit about your journey with PREIshare, kind of what it was like to get approved as an approved sponsor.
Yeah, of course. Honestly, it was a pretty streamlined process. From what I recall, it was, answering a questionnaire and just filling out kind of some of our track record, our background. And what I liked, it was very thorough, really. It was, making sure that me as a sponsor actually knew what I was doing and actually had the track record to be able to, get approved as a sponsor. So honestly, it was a pretty streamlined process. Not too hard for me, but I'm sure you guys were doing a lot of due diligence on your end. But no, yeah, it was a great process. I think it was very well put together, and felt like you guys really put the time and effort into like thinking about, okay, we're not just going to accept anybody in here, but we really want to work with sponsors that are legitimate, that are qualified, that have good, ethics and values. So I really appreciated that.
Thank you. Yeah, we really do want to work with experienced sponsors. A lot of people say, hey, I'll come to you when I have a deal. And I think it's really important for sponsors to know, there's a really great book out there. It's called The Hands-Off Investor. And he talks about, is it the jockey or the horse that won the race? Is it the pilot or the plane that got you there safely? And that allegory of, is it the sponsor or is it the deal? And for us, it's really both, but there's no reason to not have sponsors already approved so that we're in your back pocket ready to go for when you're in that raise. That's not the time that people want to apply for anything.
Yeah.
So thank you for going through that process, and we'll be able to work together when you're ready.
Great.
So can you tell us, what is your understanding of PREIshare now? Because with so many new things that we offer, it is kind of a learning process. What would be your spiel to a neighbor or something to explain what PREIshare is, what we do?
Yeah, good question. I think to try and keep it simple, it's, when you're operating real estate or handling syndications, large deals where you're pooling money together from multiple investors, right, that invest in a specific deal or deals, a lot of times those investors get locked up. Their shares or their interest in that property gets locked up for several years, sometimes up to 10, 15 years, depending on the deal. And, although the returns may be great, that kind of binds a lot of investors' hands to not be able to go out and use that capital, or if they, have a life emergency or something changes in their financial situation, they need to tap into that money that they've invested. They have no options, right? Traditionally. So that's where, as far as I understand, PREIshare comes in. It allows those investors to sell their fractional ownership or their equity in that deal on kind of an open marketplace, right, to other investors that may want to invest in that specific deal or trade. So it just allows a broader option for investors to not have their equity or but to be more liquid, really.
Yeah, liquidity is definitely one of the key points that we want to have, and then we also want to do some of that vetting process as well. So kind of one of the many benefits of our approval process is when somebody knows that the sponsor has gone through the PREIshare approval process, they know some of that background work has been done. I'm sure you understand that many of the investors that come into a syndication don't do a lot of their own research, quite frankly. Often it comes because they know somebody, or they know somebody who knows somebody, that's doing a deal. And we want people to be a lot smarter about the way that they place their money so that the industry as a whole becomes better, and it kind of raises the standard in that fashion.
Yeah, that's great. I think that's needed. I think that's something that's definitely lacking in the industry for sure, is, when the average investor that may have, 50 to 100 grand to invest, but maybe they haven't invested before in these types of deals, they really don't have a resource to do that, that due diligence. Or they, when I'm raising money, a lot of the investors, they ask me like, hey, what questions should I be asking you? Like, they don't even know what to ask, right? So I think PREIshare does help solve a lot of that.
I mean, that's a great topic, actually. What do you tell them when somebody asks you, what questions should I be asking? What do you tell them?
I mean, I try to just be honest. Like, I would say, if I were you, this is the kind of thing I would want to know from a sponsor. Like, A, what's your track record? I mean, the obvious things, like, what's your track record? Like, how many deals have you done? How many years have you been in the space? But I think some of the important questions, like, have you ever done capital calls? Like, have you ever had a deal? Tell me about the deal that went sour. Like, I don't want to hear about all your wins. Like, tell me about your losses or your struggles and how you navigated that, right? Because you want to know, when you're investing with someone, that, yeah, it's easy when things are great, but what happens when stuff hits the fan? You want to know that they have a plan, a backup plan, or they have a strategy, or they've been through this before, so they know how to navigate things, right? And I think we're seeing that in the market right now, is a lot of people are kind of scrambling, right? So it's kind of revealing a lot of the bad players, or maybe not bad players, but players that didn't really think through their investment or their strategy.
Well, and once again, it's that, is it just the sponsor or is it just the deal? The sponsor is so important. How do you handle that? You can have the very best deal and a sponsor can still mess it up. So people really should do their homework on sponsors.
Yeah, and what we found, right now is there is a lot of people being brought to the light, right? And there's a lot of people, I think, that got into real estate because of the allure and the high returns, and they look at syndications, and maybe they looked at the process of getting the deal, but didn't focus so much on the operations. What do you think is more important? Finding the deal, finding a great deal, or being able to operate the deal?
That's an interesting question, because that's something we've really been focusing on the last 6 months. I think there's so much emphasis with all these different groups on, finding good deals, on underwriting the deals, on raising the capital. Like, the whole front end is really where all the emphasis is put. And then once you close on that deal, you got the money, you close on it. Like, I've seen a lot of people, that's where they fail. Is just in the operations, is the execution of the business plan, right? So we internally have been making a lot of changes, building our team, our processes, our systems to ensure that our management of that asset, of that opportunity, goes smoothly, right? In fact, we just took all of our management in-house. Before, we were using third-party managers and kind of relying on them, but we realized, hey, that's not ideal, it's not working out. So as a sponsor, we're like, hey, we want to take care of our investors the best we can. So we're going to take the time and energy to invest in, in-house operations for management. So I think that's huge. And I think a lot of groups that's where they fail, is that they don't know how to operate the asset. They're really good on the front end. They're really good at being flashy and showy. And that's kind of the more exciting part. The boring part, which was where all the money is made, is on that back end, is on the operations and actually executing.
Yeah. And it's interesting you say that, because we've interviewed enough guys now that have $500 million or $1 billion in assets under management, and all of them follow a similar path for the most part, where they get started and they start managing, but it's usually by hiring a bunch of outside resources, and they all realize, we need to bring this in-house. I need to control it. I no longer can take somebody else's excuses if management isn't going the way that we want it to go. So congratulations on taking that next step.
It's a hurdle, but it's worth doing. And I think as you grow and as you expand, you realize that's kind of the necessary evil you have to take on. And it's amazing once you do, and as we've seen this on our own properties, that once we took that in-house and had more control, like our revenue skyrocketed, our NOIs are increasing, which just increases overall value, right? So, but I think it's like you said with your other guests, it's just part of the process, right? You can't go in from day one, go out like, hey, I'm going to start my own management company, I'm going to go buy a deal. Like, that's just too much. So you kind of have to take it step by step.
So, what kind of deals are you looking for right now? Because we know things are a little different. And you mentioned the importance of scouting out the right deal. What does that look like for Soar Capital Group right now?
Yeah, good question. I mean, as you know, the market's just crazy right now. A lot of uncertainty, a lot of people waiting on the sidelines, kind of holding their cash to see what's going to happen, right? And holding their cash for future opportunities, because a lot of people are speculating that there's going to be massive, foreclosures or, defaulting on debt. So, the interesting thing is we come from a kind of a different background. I started as a realtor and then a home flipper and then a wholesaler, right? So I've always kind of worked in that space of finding direct to seller deals, right? So finding off market, deeply distressed opportunities. And that's kind of the world I come from. And that's where Soar Capital was born out of is that we were finding all these good opportunities, outside of brokers, outside of the MLS, all these things. And people were coming to us being like, how are you finding these amazing deals? I'm like, well, I'm creating the opportunity because I'm going direct to the seller. So that's a big thing that we do. We spend a lot of money on marketing. We have a team that is negotiating with owners directly. So we're not just kind of sitting on the sidelines waiting for deals to come to us, which I think a lot of groups do. And there's nothing wrong with that. And when the deals are prevalent. But as we've seen right now, there's just not a lot happening. So you kind of have to go out and create the opportunity and kind of be a little more proactive at finding and negotiating and structuring those deals. And I'll say this, the traditional method of just getting debt and raising capital, deals just aren't penciling. So you have to get creative.
So, quick question. When you are penciling the deals, is there anything that you're changing right now to kind of go, well, it is a little different market, so let's add this or take this away? Or are you just sticking to your usual format and, finding those? Can you still find the deals with your original format? I guess that's my question.
Good question. Yeah. I would say no. I mean, you definitely have to adapt, right? Every market's different. Every circumstance is different. So you can have a model built out, but you have to really think big picture and long term. I mean, that's how we think and that's how we underwrite deals. It's not like, hey, this is not we're not going to underwrite this for a 1 or 2 year quick flip, right? Like, hey, well, what if in 1 or 2 years the rates are even higher, the market's even worse? If that's your exit strategy, then you're going to potentially get really burned and lose a lot of people's money. So, how we've changed and adapted in the last year is really been modeling out an exit of 5 to 7 up to 10 years, worst case scenario. And if, hey, worst case scenario, this does happen, can we still make a good return for our investors? Can we still come out on top? That paired with just underwriting at realistic numbers, right? Like not assuming for appreciation, almost assuming for the opposite. Like, let's assume this property goes down in value. Let's assume rents can continue to go down or occupancy levels go down. So we really take a broad view. Same with like interest rates. Let's assume those go up, and our debt structure is different than we're underwriting. So we don't base our numbers off best case scenario. We're always basing it off, maybe middle or closer to the worst case scenario. Can this deal still pencil? Can we still get a good return? So,
well, and I know some of the best investors, to have ever lived, they base everything as if they would hold it forever, right? And so when you're looking at it from that perspective, I think that it's smart. Hopefully, with the liquidity that PREIshare offers, that can still allow you to capture a big share of those investors, because many times, I would say at least 7 out of 10 people that choose not to invest, it's because of the liquidity factor in real estate. Do you think that's going to make a difference in your raises?
Oh, definitely. Yeah. In fact, on the previous raises we've done over the years, that's a big question investors have, like how long is my money going to be out? And when you start throwing out, it could be 7 to 10 years, like you lose a lot of people because they're like, oh man, 7 to 10 years, that's a huge commitment. That's like a marriage. Like I'm marrying you guys as your group for 7 to 10 years. And I don't know if I want to do that, right? So yeah, I think the liquidity is huge, and that's going to open up a lot of investors to be more comfortable in investing these types of alternative assets or outside of the stock market, things like that, because there's a little more comfort and an option to exit if they have to.
Yeah. Now I'm curious, you guys started out, as you said, you were traditional real estate, then you got into flipping, then you got into wholesaling, but you've been direct to seller throughout your career. How does direct to seller in larger deals that you're syndicating, such as multifamily and whatnot, differ from going out there and finding a standard house flip?
I mean, surprisingly, there's a lot of similarities and some few differences, but at the end of the day, you're dealing with people. You're dealing with human beings that have emotion. That's the interesting thing. So a lot of our deals that we're finding direct to seller, we're not necessarily going out and targeting a big hedge fund like a Blackstone saying, hey, do you want to sell us your distressed property? Like, that's not our target audience, right? Or our target client. It's more of the mom and pop operators. So people that have owned properties for 10, 15, 20, 30 years that may be self-managing or mismanaging them, right? So in that sense, it's the same. We're contacting owners and asking them if they want to sell. But I think the difference is sometimes it's a longer process. It's not like someone that's, losing their home to foreclosure next week and needs to sell their house fast, right? It's, hey, yeah, I'd consider selling this, but I'm not quite ready. I'm retiring in a year, call me then. So really it's just a lot of follow-up, right? Just keeping in touch with them. In fact, I have a friend that is another real estate investor, and one of the best deals he did, he said he followed up for 9 years with the guy. I mean, that's sometimes what it takes, right? It takes commitment, it takes dedication, it takes long-term view of, hey, I'm in this and I'm gonna keep at this for several months or years until you actually start having that success.
What are you seeing in terms of people who are willing to sell and owner financing?
Yeah, I think that's become a lot
that changes
more.
the numbers.
Yeah, a lot more prevalent. I mean, for sure. The second rates change, I mean, you have to think about it this way. For the last, let's say, 7 to 10 years, people have been getting debt at historically low rates, 2s, 3s, 4%. So you've got 10 years worth of mortgages out there that have great rates, right? And that represents millions of units out there in the market. So you just have to be able to kind of pitch it in a way that's beneficial for both parties, right? So it's not like and typically that's what we do when we show the seller, like, hey, you could sell it, for cash, or if you were to go sell this on a traditional sale today, here's what you'd make. But if we do some sort of creative finance or seller carry, seller finance, you can actually end up making more money, have better tax benefits in the long run, and get you to your ultimate goal, whereas this option is no longer on the table. And I think that's the big pitch to sellers is, how does this benefit them? Obviously, it's going to benefit us because it makes our debt cheaper, and sometimes we have to raise less money, things like that. But if you can find a way to pitch to the seller and really explain it to them in simple terms of like how this is going to benefit them, and really just educating them, because a lot of people don't understand seller finance and creative finance. It's kind of a newer thing that I think is emerging, especially now in this market. But it's just understanding that and having the knowledge base to explain that to a seller.
Yeah, I know from traditional real estate, we're starting to talk to a lot of people about taking your rate with you, so to speak. So if you sell on seller financing, a little higher rate than you might have, then you get to transfer that to your next purchase. And on a recent multifamily purchase that I did, I just talked about the fact that you've trusted this asset to pay you for over 10 years already. You just don't want to deal with managing it anymore. Why don't you just trust this deal to continue to pay you, but I'll take over the ownership? So that's some ways that I've been seeing, that conversation be breached. What are some of the ways that you breach it, maybe on some of your deals?
Yeah, no, that's a good question. One thing I like to kind of highlight to sellers is, hey, I want to upgrade you from a landlord to a bank. And, that kind of sparks the question, like, what do you mean upgrade me? Well, think of it this way. You as an owner, as a landlord, I mean, you're still getting called, like, again, we're talking about kind of these mom and pop operators, right? People that are self-managing or have been doing it for a long time. A lot of them you'll say, okay, well, when's the last time you got a call from a tenant? Oh, well, 2 days ago, a tenant called a leaky toilet. I have to go, call a maintenance person. I have to go fix that. Okay, well, when's the last time you had to pay taxes and insurance and maintenance issues and furnace goes out, all that kind of stuff. So right now, you're a landlord. Oh, I want to upgrade you to a bank or a lender where you just collect a check every month. Imagine your bank. Do they ever get calls from tenants? Do they ever have to deal with the maintenance issues? Do they ever have to go mow the lawn? If there's a fire, do they have to go deal with that with the fire? No, like they just collect a check every single month, regardless of what's happening in the property, right? So it's kind of a way to get their mind shifted away from, oh wow, yeah, like if I can alleviate some of this pain and the stress, because really at the end of the day, that's the motivating factor for most people that want to sell. aside from just dollars and cents, is I want to alleviate pain and stress. I want to get the pain and the stress away from me. How can I do that? And that's how we try to craft an offer or a structure around that to say, okay, what is your pain? Here, let me alleviate that by doing this. Right? So there's a million ways, obviously, to structure a deal, but the first step, I think, in really pitching this and understanding if a seller is open to this is just understanding what is their pain point, how can you help them with that, and then you craft an offer around those things.
Yeah, that makes a lot of sense. I mean, I think it's been about a year since we last sat down and talked. You've acquired a couple hundred more units, I think, since then. What are the most recent deals that you're doing, and what are some of the highlights of those?
Yeah, great. Yeah, so I think the last time we met, so we've closed on at least 2 or 3 more deals. So we do multifamily and mobile home parks. So one of my partners specializes in mobile home parks, so we kind of do those 2 asset classes. But we just closed on a 278 unit mobile home park portfolio out in Kentucky. So great deal. I mean, the reason we love not just multifamily, but mobile home parks is the returns are still really good. Or I feel like they've been really compressed in multifamily for the last several years, but you can still find really good deals from mom and pop operators. That was a great deal. We ended up raising about $4.2 million on that. Just took that down a couple months ago. So that's very fresh deal that we just did. We also did a deal in San Antonio, Texas, a townhome project, 44 unit townhomes there in San Antonio. And we're turning that property around, again, kind of a distressed property. But ironically enough, both of those deals were found through brokers that we've been building a relationship with over the last 2 or 3 years. So again, just to bring this back, like it's not like you can't find deals out in the market through brokers, but again, it all comes down to relationships. So so there's a couple of deals that we just did, and we're now on the hunt for our next one.
Yeah. What are some of the ways that you work with brokers? I mean, obviously, these are 2 completely different markets, so you have 2 completely different brokers. Why are they choosing to bring those deals to you, for example, versus somebody that's local to them?
Yeah, good question. I think initially, if you're just starting out, I mean, it's going to be an uphill battle, right? Because you're going to basically cold call some brokers and trying to convince them to bring you deals. And they may bring you deals, but whether or not they choose to go with your offer versus someone else they've already worked with is another story. So initially, it is tough. I mean, you kind of have to build that credibility. I think first thing is just being consistent. Again, our acquisition guys, they're constantly calling brokers every week, 2 weeks, emailing them every month, It's just a sheer fact of like, hey, this guy's been hitting me up nonstop. He must be pretty serious, where I haven't heard from this other guy for a year. Why would I send it to him? You know what I mean? So again, brokers are human beings. You have to bring it back to the human element. If the squeaky wheel, what is it? The squeaky wheel gets the grease, right? It's the same concept with brokers. Then beyond that, I think the important thing is to show track record, show ethics. And, this goes for sellers too, but, the confidence to close. I've talked to so many brokers and sellers that, especially in this market that we've had the last six months to 12 months, that have been frustrated. They've gone through 4, 5, 6 different buyers that have just backed out when they thought, oh, these guys were serious. And then come to find out before their due diligence, they just back out. Couldn't find the money, couldn't get the debt, couldn't whatever. So we show hey, look, we have a 1 or 2 pager of here's our recent deals we've closed. We've actually closed on these. We can verify that. We can have you call the broker that we worked with or the seller, right? So it's the confidence to close. In fact, the last deal we did in Kentucky, I was just telling you about, we were under contract with a seller who'd been under contract 3 different times in the past several months, and he had zero confidence that anyone was a serious buyer. He was just so frustrated. Is there an actual buyer out there that can actually close? And so when we were negotiating with him, even during our due diligence, he was just frustrated, and he was pretty hard-nosed. And I told him, I was like, Jim, on the phone, I was like, Jim, I'm telling you right now, we are going to close. We are going to close this. I can promise you that. And he kind of paused. And he's like, okay, I'll see it. I'll see it when I'll believe it when I see it. And we did close. In fact, we actually met in person after closing out on site. And I looked him in the eye. I said, I told you, Jim. I told you I'd close, right? So it's just building those types of relationships and the confidence. And the more deals you do with brokers, obviously, the more confidence they're going to have in you to actually perform.
What does Soar Capital look like as far as staff? And I know that you've talked a lot about follow-up. So you've got to have a lot of data that you manage. What does the staff look like, and what is the data aspect of it?
Yeah. Good question. Yeah, so we're a pretty lean company. We're very small. I mean, compared to other guys managing billions of dollars under management, we're a smaller, I would say boutique group. So we have, full-time acquisition manager, a relationship manager. There's me and a couple different partners as well, office assistants, and so we're a pretty tight staff. And again, like I said, we have an in-house management arm of the business. So we have several staff there, virtual assistants that help manage our assets now. As far as the data, we pull a lot of data from all, CoStar, Reonomy. So we're constantly pulling lists, targeting specific owners in different regions with different criteria. And then again, we do a lot of direct mail, cold calling, texting campaigns, just trying to get in front of people, asking them if they want to, sell us their property. So yeah, we have different software that manages all the data and helps us with our list management.
And are you still doing that on a large scale for wholesaling in addition to your syndications, or have you turned more towards specifically targeting owners of larger properties?
Yeah, we've definitely shifted towards just larger deals, larger properties, but we still have that arm open, and we still do some marketing for the kind of the smaller deals as well. But now that we're outside of just Utah, we're in multiple states, we've definitely had to expand that.
I was going to ask you, you probably mentioned this on your last interview, but it sounds like it may have changed. What areas are you in? Where are you looking?
So yeah, we've really done a lot of research on emerging markets, what we call an emerging market, right? So we really like to target a market that is not necessarily fully blown up like Utah is, or like in Atlanta, Georgia, or somewhere like that. It's a main metropolitan area where every investor is trying to find deals there, right? So we target specific data looking at, okay, what's maybe a secondary or tertiary market that has a bright future in the next 10 years, right? With job growth, economic growth, rent growth, all the things that you look for. So we've identified, 5 to 10 different markets across the U.S. that kind of fit that criteria. So a lot in Texas, some in the Midwest. Again, for the mobile home parks, that's kind of where most of those are. So yeah, like I said, like Columbus, Ohio, we like that market. San Antonio, Dallas, Fort Worth, those are another market we like. We're in Indiana and Kentucky for our mobile home parks. So yeah, it's a data-based approach. It's not just throw a dart on the wall and be like, hey, let's buy there because that sounds fun. It's really looking at, hey, where is this market headed? Can we achieve these returns, assuming, these things are going to happen based off the data?
Good for you. I want to take you in a little bit different a direction. See if we can get you to divulge some of your secrets. But I know you've done so much value add. I love asking people and finding out what have been your most lucrative value adds, or is there anything that you'd say, yeah, I wouldn't spend money on that again? What have you seen there in terms of patterns?
Good question. I mean, I think my answer is going to be probably pretty similar to what anyone would tell you, but like the properties that always do the best are in good locations, right? Good areas, safe areas. I think the area is so key and crucial. Having good debt, again, we kind of already covered that, but ensuring you have good long-term debt, having the money to actually do the deal. So I think location is key for us, making sure our asset's in a good spot. It's easy to get kind of the shiny object syndrome or the FOMO, like fear of missing, like you haven't done a deal for a few months or a year or whatever. It's like, we just got to buy something. But that's where you can really get killed is you're sacrificing on your numbers, right? Or your standards of where you should buy and what you should do. But as far as like renovations, because we typically do heavy value add, anywhere from 20 to 30 grand a unit in renovation. So that's pretty big. Most groups are a lot lighter than that. But we're not scared by the heavy value add. I mean, we come from construction background and flipping and things like that. So, obviously the things that pay off the best are, upgrading kitchens, even if that's just resurfacing countertops, painting cabinetry, new appliances, So we try to target things that are appealing to a tenant, that are going to add, curb appeal. We're huge on curb appeal. Just turning around the look of a property, making it feel inviting and warm for a tenant, is going to bring tenants in, and they're willing to pay more, and things like that. Another big thing we do, especially in our mobile home parks, which is kind of fun, we offer discounted rate for police officers. So we want to get a bunch of police cars in there. That's going to eliminate crime. It's going to bring a better tenant base. So there's little strategies you can do, in investing and when, turning around a property that aren't going to break the bank. Again, big ticket items, a lot of investors are like, whoa, let's put in a pool. It's like, whoa, hold up. Is that really going to give you a return on that investment? Does that matter to a tenant base, right? So we do a lot of market data and research, even calling other properties surrounding ours saying, hey, what kind of specials are you offering? How hard has it been up to lease the 3 bedrooms versus the 2 bedrooms, right? So it's really just taking a holistic approach and kind of the big picture when you're looking at investing in deals and understanding all of it instead of just focusing on one little thing of like, how much money are we going to make,
Yeah. Do you have any initial formulas that you go off of? I mean, I always hate to throw formulas out there because people will rely on a formula rather than doing the hard math, which I believe you always have to do the hard math. But oftentimes to weed stuff out, I mean, you said you're spending $20,000 to $30,000 per unit. Is there a certain dollar per unit that you'll look at versus won't look at?
No, not really. I mean, it comes down to what's your ROI on that investment, on the capital invested, right? So you kind of have to look at that. If it's a heavy value add and we're going to have to put 20 or 30 grand, it's like, okay, what's our rent bumps going to be at that? And typically, if it's that big of a renovation, we're talking, it's rent, a unit's maybe renting for 500 and now we're going to be renting it for 1,000 or 1,100. Like it has to be a huge, significant number. And we've underwritten deals where it's like, hey, it's a value add. There's room to raise rents, but it's like if you can only raise rents $50 a month, I mean, it's not worth investing $5,000 a unit or $10,000 a unit into this. It's just the numbers don't make sense. So as far as the renovation, that's some of the things we look at. I mean, as far as calculating, I mean, our model is very robust. So as far as like underwriting a deal, that's a whole nother thing, right? But the simplest terms is like we're always trying to get a certain return for our investors, and obviously making it worth our time too. That's the other thing you have to look at as a sponsor. Again, we put a lot of emphasis on the investor, which we should definitely. But as an investor, again, this goes back to the questions maybe an investor could ask is like, well, how much money are you guys going to be making on this? And is it worth your time, right? Because so many times we'll underwrite a deal and be like, this is awesome. And then we actually look at what we're going to make as a sponsor, and it's like, this is not even worth it. Like, why would we do this? It's not worth our time, right? So, and as an investor in those types of deals, I don't want to know that because I'm like, hey, if it's not worth your time, then you're not going to put all your energy and focus into this. If it's only making us money, you know what I mean?
It's hard to make it a priority
Yeah.
if it isn't,
Yeah.
paying
So
your bills.
we have to be excited about it too.
And then have the discipline to make sure that it is the right deal all
Exactly.
the way through.
Yeah.
There's a few people that speak in real estate, and I think, ooh, I would love to see behind the curtain on how they run all of their analysis. And you're one of those, like, I would love to know. Sounds like you've learned so much by maybe skinning your knees
Oh yeah.
and picking back up and going, not going to do that again.
Yeah, definitely. I mean, I've been doing this for, over 15 years, started small and, buying duplexes and, so I've seen it all and I've made all the mistakes you can imagine making and I've lost money on deals, right? So I'm not going to paint this picture like we're perfect and we've done it all right, but definitely have learned the hard way and learned what doesn't work. And I think that's the important thing. And sadly, the thing I see a lot of people get out of real estate investing or move on is because they've had a bad experience. And they're like, well, I can't do it. I had a friend actually, he was like, I want to flip homes. He bought 5 homes and he lost money on every single one. And he's like, I'm never going to flip a home again. I'm like, well, what did you learn? How could you, on the next one, how could you be better? How could you implement something that's going to make you money or avoid those same mistakes? And I think for me, that's how I look at it. It's, you kind of have to get in this space where you're comfortable with discomfort in a way. You have to get comfortable learning the hard lessons and failing and be like, okay, instead of just giving up, pouting, I'm just going to learn from that. And I'm going to improve. And eventually, I think that's how, the most successful people, whether in real estate or any other businesses, they can brush it off, stand up, and keep moving forward.
I totally agree with that. And I think that any good syndicator is good at not being in their comfort zone. Because if they weren't, they wouldn't be there.
Yeah.
And I do believe it's a mindset thing. I mean, I remember one of my very first mentors, he said, when somebody said that 99 out of 100 businesses failed and his first business failed, he said, all right, I just have 98 more to go. Whereas everybody else was saying, why are you getting into business if 99, fail? And so I think there's that mindset of knowing, okay, if I can learn from every single mistake. It took him 5, by the way, to never have to work for somebody again. So, how many businesses does it take starting in order to get to that place where you never have to work for somebody again?
I think, it's easy to give up quick, right? And especially in real estate. I've known so many people, and in a hard market. I got in the market in 2008. So I kind of entered into my real estate career like right at the worst time. But for me, it was the best time because it's only been on the uphill. But ironically enough, now we're kind of going through a similar cycle. We'll see how severe this cycle is. But it's tempting to kind of fall prey to that same mentality of like, oh my gosh, the world's falling apart and I should just liquidate everything and do something else, right? Like, I think that's the human side of us wanting to protect ourselves. But the other part of me says, okay, wait a minute. Back in 2008, this is all happening. And then after that, there was these amazing opportunities, amazing deals. That's going to happen again. So I want to be ready for that and prepared mentally and financially for that so we can implement that. But right now, it's hard. It just sucks, right? There's not a lot of deals. Things are struggling. Like, properties may not be performing like you want, but you just have to push through that and find a way to capitalize on the next opportunity that's in the future.
Yeah, that makes sense. I'm going to take you back a little bit because you talked about emerging markets, location, right? It's always been said in real estate, location, location, location. But I don't think a lot of people even understand what that means or what they're looking for. I think about our CEO, Michael Anderson, and he built a $1 billion portfolio by taking investors from established markets who are highly invested to get very little return and taking them to emerging markets where they can invest that same amount of money and they could probably get triple or quadruple the amount of return on their money. And I think about a data scientist like Neil Bawa that we had on the show, who takes all of this data and he's looking at these markets and he feels like he has to be 18 months ahead of the rest of the market. So I'm wondering, from your perspective, if somebody's hearing emerging market, but they don't really understand what that means, what are some key indicators that you look for?
Yeah, and again, you can get very granular like Neil. Neil's a great guy. I definitely look up to him because he's on another level of sophistication. But for the average Joe like me, right, just the average dumb guy, there's some key indicators you can look at. Again, I talked briefly about them, but like job growth. So, and there's data out there you can pull just online for free of this information. Obviously, you can pay for some of it, but okay, what, you think about it, okay, where are jobs heading? And what are the indicators showing over the next 5 to 10 years? Right? Or maybe what are some big employers that are coming? Like we look for, in fact, our deal we just bought in Kentucky, Ford is building the largest industrial plant in the state of Kentucky, 10 minutes away from our property, right? So you think, okay, well, and that's going to bring 7,000 permanent jobs. Okay, well, that's an emerging market. That's a sub-market, obviously, in a little pocket, but that's going to bring substantial growth and population growth because of that. So you look for things like that. And again, it takes some digging, it takes some time. But I think the best place to start, let me talk about that in a sec. But other things we look for, again, rent growth. So again, projections, economists make projections. Okay, where are the rents heading? Have they been historically low in this market? And do we feel like they're going to grow because of all these other factors? So I think with just 2 or 3 key points, you can get very granular and look at all sorts of different metrics, but we just look at job growth, population growth, economic growth. Are there opportunities for, new employers and things like that? So is it a market that's growing or dying? In fact, we owned a deal here in Utah in a very tertiary market. This is years ago. Found it really, like, on paper, it looked great. Like, oh my gosh, we can buy this for pennies on the dollar, but had I known now what I know, had I known then what I know now, I probably would have never bought this asset because it's in a market that's literally dying. It was an oil town. There's no more oil. Literally, like, if you look at the graphs, like, population is declining every year for the last 50 years. It's, okay, well, that's a red flag. Population's dying. Rents aren't going to be going up. People are going to be liquidating houses and property. So luckily, we were able to get out of that and make a profit. But, it's things like that you just want to be careful of and cognizant of. and just avoid, again, the shiny object because of the price per unit looks great, or, oh my gosh, I can buy this for so little. But you have to think of all the other factors when you take that into account. And so I guess what we're saying, this can be daunting. Like what we're talking about can be very daunting for someone that either wants to just get into real estate investing. Is like, I don't have the time. I don't even know what you're talking about. Metrics. You're talking about data research. Like, I just want to buy a rental. I don't know. Like, break it down for me. So I think the best place to start is just in your own backyard. I mean, that's where I started. I didn't start buying deals out in Texas. I don't know Texas. I never lived there. I don't know anything about it. I knew my neighbor next door, though. I knew what his house sold for, and I can walk by his house and see what he did to it. So I think just for those who maybe are getting into this, even investors that maybe want to invest in syndications. I know a lot of investors are like, I just want to invest in something local first, just because I know it makes more sense to me. I have a more comfort level with that. So I think there's nothing wrong with just saying, let me start with a property or two, start small, start local, and then you grow from there and you figure it out, right, as you scale.
Smart. So maybe not baby steps, but also not large leaps.
I mean, there's something to be said of taking action and going big, but I think going big, you have to go smart. It's not just being foolish, but I think you do have to kind of dream big if that's what you want to do. But I don't think there's anything wrong with saying, hey, that's where I started. I was like, I want to buy a property a year. At the time,
and you lived in that property.
Yeah, I
right?
lived in
Your
that
first
property,
one
and I've told that story on the first show I was on. But it's just, it's as you grow and as you do more deals and as you learn more, your vision kind of expands, and your ability to do bigger and better things expands as well.
Well, I think this is a great transition to talk about the passive investor, because you mentioned that some people just want to put money into a deal locally, kind of see what's going on. There's a lot of people out there, they don't want to be the real estate investor. They don't want to be the sponsor. They don't want to operate the deals. Maybe there's a little bit of allure to it, but the reality is they're really good at what they do. They might be a doctor or a dentist. They might be a professional or a business owner. There's a lot of the people that are investing into our syndications, right? And so what are the big benefits to a passive investor inside of a deal?
I mean, I think it's all of the benefits, really. Like when you break it down, obviously, there's the potential upside if you're going to go and buy a deal yourself, operate it, do all the work, and then sell it or whatever. There's the option that you could make more money, right? So that's the appeal for that kind of person, is like, well, I don't want my return set. I want to have the upside potential for much more growth. Well, great, but you also have the potential for a lot more loss, right? And mistakes being made. So most of the investors that we work with, again, they're, like you said, high net worth individuals, doctors, dentists, or even business owners. And surprisingly enough, real estate investors. I mean, I invest in other people's syndications as well, because I recognize how much work it is to operate a property, to syndicate a deal, right? And to go full cycle on a property. So even me being the operator that I am and the sponsor that I am, I recognize, hey, it's so nice just being passive. Like, I can just put my money over here. This guy's going to handle all the stress and the work, and I just get a check every quarter. Great, let me do that. And honestly, that's like where I'd love to be eventually, is just being the passive investor, because hands off, once you find a good operator that you know and trust and has a good track record, then I don't see a reason why you'd want to go any other way, to be honest. Why you'd want to own and operate yourself.
Yeah, it's truly one of the only true passive investments, right? And I have this conversation with people all the time. They want to get passive income. So they start talking to me about they're going to do Airbnbs and nightly rentals. I'm like, furthest thing away from passive. And they say, well, maybe I can go flip some properties. Also, furthest thing away. Even buying just a standard rental, a duplex, a fourplex, there's very much involved in that. Whereas as a passive investor, you can get to the point where you just place your money, you get your return, and you still get to collect the data along the way. I think that's one of the big benefits. And you say you invest in other people's deals. I know some of the biggest guys that I know in the industry, they're constantly placing money with other people so they can learn from what they're doing.
Mm-hmm. Yeah, you learn their systems and their processes and see how other guys are doing it, right? Yeah, so it's a learning mechanism. But yeah, I think it really is. Like, people always ask me, like, do I want to get into real estate? I want to buy rentals. I'm like, okay, well, what are you looking for? Are you looking for another job? Which is fine if that's what you want. Or are you looking to create passive income? When we say passive, it's just like you said, investing in real estate, as an operator is not passive. It's the furthest thing from passive.
Yeah, you trade some of the upside potential to truly have passive income.
On the other side of being a passive investor, there's also all the tax benefits that we know about. Let's talk about that for a little bit.
Yeah, I get excited about that.
Let's say I've never been a passive investor. I know nothing about real estate. What would you tell me about the tax benefits?
Yeah, we can talk about this too, but like I went to lunch with a doctor that like retired anesthesiologist, made really good money. And I was kind of, because he was wanting to invest in one of our deals, and I was breaking it down to him, like the tax benefits, the depreciation. And like at the end, he's like, how come no one ever told me this? Like literally, he's like, I'm like in my 60s, no one has ever presented me with this type of opportunity. He was like mad, you know? It's like I've been presented with all these like venture startup businesses that I've lost all my money in, but no one ever told me about like passive investing in real estate syndications, and there's all these tax benefits, you know, like.
Yeah. Well, I remember, working with Renatus and getting people involved in education, and I had a dentist that came to me. Luckily, he had his wife with him because he's like, I want to get into real estate. Everybody says I need to get into real estate. I'm thinking about flipping a house. And she's over here like, he does not have time to flip a house.
Yeah.
Like there's literally no time in his day for flipping houses. And I think he ended up just basically becoming a private lender on deals because that's the only thing that made sense for him was like, here's my money, give me a return.
Depreciation, how that versus like investing in stocks. You don't get depreciation, you don't get tax benefits, you know. Where I start with investors is I first just explain like the return structure, right? Everyone knows, like, hey, I've invested in real estate, I've heard about it, really good returns, I can make a lot of money. So, I first cover like, yeah, and for us, we target deals that are going to return, hopefully a 20% annualized return to our investors, 20% IRR. So that alone is like, wow, 20% return, that's amazing, right? Well, that's just that's the regular return, but then we don't, it's not even calculated into the return structure or the model, the tax benefits. And most investors have zero idea about what that even means. So owning real estate, the government wants people to own real estate. The government doesn't want to own real estate themselves because they're not great at managing anything. Or I don't want to get political, but they're not very good at managing money or properties, right? So they're incentivizing the average person to go out and own property. And when you own property, rental properties, not your primary residence, but rental properties, there's depreciation you can take, right? So huge tax benefits. I mean, I could talk for hours about this, but when you own property, you get a write-off basically on your taxes. It goes directly against your personal income tax. So when we buy rental properties, or especially larger assets, there's a huge tax benefit when we accelerate the depreciation into a few years, and basically gives the option for the investor to offset their income tax. Right? In fact, that's why a lot of investors invest with us. Is they're like, yeah, the return's great, but I'm honestly not as excited about the return. I'm more excited about the tax benefits. I made a ton of money this last year as a doctor, a dentist, or whatever, a real estate professional. I need to offset that money so I don't have to pay that to the government. And again, this is all legal. We're not doing anything squirrely or behind the door. This is literally written into the IRS code that you can take depreciation and it will offset your taxes. In fact, when I learned about this myself as a real estate investor, this is several years ago, I didn't even know about cost seg studies, about accelerated depreciation. I was just kind of learning about this because I remember I had to write like a $100,000 check to the IRS. My CPA called me up. He's like, hey, get your checkbook out. You owe 100 grand. I was like, 100 grand I don't have? Like, what He's like, well, what happened to the money you made? I was like, I don't know. I used it. I invested it, but that was the day I was like, never again. Not that I have anything opposed to paying fair tax, but if there's a legal way to reduce my tax burden, why would I not take that, right? And so that's the exact strategy that we use for investors. And when we teach them about this and how, hey, you invest 100 grand, you can get up to 50, sometimes up to 100 grand of tax benefits. That's going to offset your whole investment immediately in that first year that you invest. I mean, it blows their mind.
And for the audience, what you're talking about, the accelerated depreciation, you do a cost segregation study. There's professionals that do that, and they're basically going to look at the entire building, which would normally be Depreciated, what's the year time frame?
Residential is 27.5 year schedule.
Yeah, so
Commercial
27 and a half years. Commercial's a little different than that, but essentially it shrinks it down to those first few years, right?
Yeah, exactly. Yeah, so you're legally allowed to take all that tax benefit in that first year to 5 years, which really helps offset that tax burden. And then the question then becomes, okay, well, what happens after that? I mean, don't you have to pay taxes back? Well, theoretically, yes. Like if you sold that property down the road, then there's a recapture, right? The government wants to recapture that incentive they gave you. Well, there's strategies to mitigate that as well. You do a 1031 exchange, a tax deferral, and you can roll that to the next property and to the next property indefinitely until you pass away, and then your heirs inherit your estate at a stepped up tax basis and eliminates all taxes, capital gains, and appreciation. So when you talk about the ultra wealthy, the ultra successful entrepreneurs and real estate investors, this is literally the strategy they use. I mean, talk about the Donald Trumps of the world. People are mad that he doesn't pay taxes. Well, you know how? It's this exact strategy.
Yeah, he uses he and many use that accelerated depreciation, 1031, just defer the taxes, and then you can do a charitable remainder trust, which is another strategy where essentially you leave all of your assets to a charity, let them deal with it, but you use that money to pay for life insurance, which pays out the death benefit to your family. So now your family, it's a lot easier for them to deal with money rather than your assets, right? Not every kid has the same dream as their parents.
Yeah. Well, and I just to add to this, I think what's so powerful when people understand this. I mean, again, we're talking about really complex terminology and strategies that can be confusing, right? And I get that. But once you understand the basics of it, it's amazing because I have never found another investment vehicle that provides this type of benefit. You talk about investing in stocks, bonds, whatever, mutual funds. There's no tax benefit. I mean, you don't get a tax write-off by investing in a stock, right? But you do investing in real estate. So when I compare apples to apples, in my mind, it's like, okay, should I invest in this, or this? I mean, there's a million things you can put your money into. I always come back to real estate because A, it's one of the safest investments there is. You look at history, it's the most proven franchise model that's ever existed. How many people own real estate? And how many people do it every single, you know what I mean? Like it's a proven thing that works if you know what you're doing. So when you really compare all the different investment vehicles, to me, it outweighs the rest in benefits and honestly in returns and in the fact that you get to own a real physical, tangible asset. You own land and they're not making more of it, right?
One of the three basic needs, right? And I think we've all come to those, well, not all of us, but ultimately in our career, we come to those times where we really step back and say, what the heck am I doing? And should I be doing something else? And I've done this enough times in my career, and I'll even sit down with people and I'll analyze all of these different business strategies, and nothing has been able to beat out the potential for real estate. And then, now we're talking about when you get to a certain level, you might be really good at something else. You don't want to be the operator of real estate. So that's the benefit of passive investing. Let's mention another term that I think that is an important term, because oftentimes if we're doing a 506c offering, for example, we can only work with accredited investors. And so what are some of the benefits of getting yourself to that level where you are documented as an accredited investor?
Yeah, good question. I mean, that's a common question I get from investors is, A, what is an accredited investor? Like they've never even heard the term, right? So again, the SEC, the government wants to ensure that me or we as operators aren't taking advantage of people, right? Which is great. I think this is an awesome thing that they've done because they want to protect the public from sharks, right? That are going to take advantage of them. So being an accredited investor, it's basically it's not even a process. It's just you have to achieve a certain level of wealth, and there's different criteria that the SEC has for what that looks like. Have to have certain net worth, excluding your primary resident. I think it's $1 million, and then over $200,000 or $300,000 if you're married of an annual income for the last couple of years. Those are the two kind of main criteria to become an accredited investor. But again, whether that's a 506c or there's other deal structures as well. You can self-declare, as self-accredited, or you can get your CPA to say, yes, this is an accredited, I've reviewed their tax and their finances, and they meet that qualification, so they are technically a accredited investor. So I think the benefit of that is that it opens the door to be able to invest in deals like we're doing. Right? If we're raising funds through a 506c, you have to be accredited. You cannot take funds from someone that is not accredited, right? So it kind of opens up the door to more opportunities to invest, not just in real estate, but honestly in a lot of other things. It gives you the option to just be a more sophisticated investor. And I think, to be honest, like, you should be educated on what that means and what it means to invest in opportunities, right? Because we've all been through this. If you've raised funds, I've talked to guys that are like, hey, I've got 10 grand to invest, and they're so scared and nervous. They don't know what to do. They're like, this is like their life savings. And typically those are the hardest investors to work with. They're the most needy, the most misinformed, and so I get it why, like, hey, we can't work with you. Like, once you get to this level, great. And I've been on the other side of the coin where, I'm getting checks written for $1 million, $2 million from a single individual, and they hardly even ask questions. They're just like, where's the bank account I need to wire this to? Because they're that sophisticated. They've done so many deals, you know what I mean? So yeah, definitely being accredited, learning what that looks like, because there's other qualifications too, is crucial if you want to start getting into the larger real estate game and investing in PREIshare or other syndications.
Does Soar Capital, do you run 506Cs, or what's your norm?
We do both, depending on the deal and the deal size, because again, we've done a lot of smaller deals where we'll just raise money from one investor or 2 or 3 investors, where we don't necessarily need to set up a full 506C and go through that legal process. But yes, we will do 506Cs depending on the deal size as well.
We can't wait to have you standing right here telling us all about them.
Yeah.
Yep.
I look forward to it.
Yeah. What is on the horizon for Soar Capital Group? What are you guys most looking for right now?
So again, I think it's mostly off-market, direct-to-seller, good opportunities. And again, we're being very patient. Like, we're not rushing into something because we feel like we need a deal, or I have investors calling me all the time like, hey man, I got money, I want to place. I mean, that's the hardest call to have, because you're like, I wish I could put your money somewhere, But at the same time, I want to ensure that we're protecting our investors' interests and not being sloppy or misaligned with what their goals are, and making sure we're protecting them. So we're just saying, hey, we're gonna kind of like a lot of other people, we're gonna kind of wait this out and see what's happening. We're gonna be very cautious, very conservative, and we're gonna ramp up our direct to seller focus, because I think there's a lot of sellers out there right now that are hurting behind the scenes. There's obviously the ones you hear about that are going into foreclosure and banks are taking properties back, but I think there's a lot of sellers out there that are scared that maybe their debt has, their monthly payments have gone up, maybe their rents aren't going up like they thought, and they're kind of in a hard spot. So that's where I get excited, is I can go out and actually help a seller in distress, right? So that's where we're focusing our efforts, is direct to seller, creative finance solutions, seller finance, where we can make it a win-win for us and for the seller and for our investors.
That's great. Clay, I'm glad we were able to have you on the show again.
Thanks for having me.
Congratulations again on being approved, and we look forward to placing some capital with you.
Yes, thank you so much. Appreciate you guys having me.
If you are a real estate sponsor and you would like information on becoming a PREIshare approved sponsor, please just visit us at PREIshare.com/sponsors. And also check out our group of investors and sponsors at PREIshareCommunity.com. And we would like to thank you for being here today, and again, congratulate Clay.
Thanks, everybody.
See you next time.